I'm going to update a couple markets this weekend, and there are a few in an important position. The first one I wanted to look at again was Apple. I realized that I didn't show a longer term chart of this on the last video when I pointed it out. So this is a daily chart of Apple. I saw this big wide range bearish engulfing pattern on Wednesday, and what I showed was this light red trend line here. So there was a weekly high in April 2010, a weekly high in February 2011, and then that upper channel line there was hit on that Wednesday, the day of that reversal. And I talked about how with growth stocks, Investors Business Daily recommends selling at throwovers those upper channel lines as a sell point. But what I did want to show is go back to a longer term chart here, and so we just looked at that light red trend line. What you're actually seeing here is back to the 1990s, and this is where Apple topped in the tech bubble. So March of 2000 experienced a major correction, so it went from $37 down to $6. So pretty big bear market there as far as Apple goes. Then it had another big bull market from 2003 to the end of 2007. Had a big correction there during the last bear market, and then it's continued up. But what we saw is this past week also, this dark red line, this upper channel line from those two bull market highs was also exceeded. So this is really an interesting point for Apple. We have a throwover of two upper channel lines. I think it is going to be significant. So I did want to point that out longer term. And I wanted to click over to gold 2 and just show that a similar thing happened there. I think I pointed this out on the blog this past summer. But let's look at it here. This is a gold daily chart. Let's go to a weekly chart here. Okay. So one way to look at this was the trend line up from the 2008 lows. So if you look at this trend line from that high to that high, we saw the market pierce that and then reverse, and then it did actually come and make a slightly higher high before it sold off on this correction here. But that would be similar to the smaller trend line, or the first trend line I showed on Apple there. But then the longer term trend line is, here's the high of the 2006 bull run in gold, corrected, consolidated for a year or so. Here's the high of the bull market into 2008 in commodities there. And if you look at that light blue trend line, so from there to there, you also saw the market just come up and just tag that upper channel line there at the highs as well. So that'd be similar to what we're seeing in Apple there. In fact, if you take this back to a monthly chart, this first significant swing high here up in that bull market since 2001 in gold, the market almost got up to that upper red channel line there. But so similar thing happened in Apple. I did want to point that out because that's a market leading stock, and as those leading stocks go, so goes the market, and I think that's an indication that the market is going to top very soon here. These are the general stock averages. This is the New York Stock Exchange here. Market did push to a new high relative to the prior week. However, on the daily chart, there's this sharp bearish divergence in the RSI now, and basically all the oscillators look like that. There's a very significant lower high on the oscillator relative to the slight higher price high. And that's a pretty nice looking chart one. I would say that if the market does reverse and takes out those lows from the low corresponding to that RSI dip there, it will probably experience further significant correction. I think it would probably be set to break that lower wedge line boundary if it does that. All of the indexes look pretty similar here. NASDAQ, there was a bearish engulfing pattern Wednesday, same day when Apple had that big sell-off there. It did manage to push higher the last couple of days, but there's this sharp bearish divergence there. So again, look for it to take out that that swing low there, That's also where the market basically broke out above the, let's click over to weekly chart, the prior bull market high to this 2011 high, that resistance line there. So the market moving back underneath that line there may be an indication that the breakout is not successful there. Russell 2000, this is the one I've suggested looking to short because of the position it's in. And I think last video I mentioned, look for the daily stochastics to make a bullish cross up, which it did on Friday. Basically moving up to another high there, but it's setting up again a divergence here. So if this then turns down and crosses down again in the next day or two into a sell signal, you now have a nice strong bearish divergence on that stochastics to take an entry signal with a stop above whatever highs are here. So that would be if that happens, that would be the tight, very low risk, high reward entry. But I also did talk about waiting for that lower boundary of the rising wedge to break there as an added measure of confirmation that this rally is complete. Looks similar across basically all the markets here. Let's look at the S&P 500 for a minute. The S&P is about 0.5% where it is now from taking out the high from first trading day of May last year. So it may be good to see that high taken out prior to a reversal, so who knows what we'll see early this week. But I would say there is a tendency for markets to slightly exceed important highs or lows before major reversals there. So if we're that close right now, I would say the odds probably favor that high being exceeded early this week at a minimum, even if the market does reverse. Can't guarantee that, but the Dow already did take out that high a week or so ago there. I think the Russell and the New York Stock Exchange are probably too far away to take out those corresponding highs there. Last one I wanted to look at is oil. I had updated on this a couple weeks ago when the market was down in this area here. All right, and we're coming off this really strong bearish divergence in the MACD relative to price there. Looked like the market may be topping, however it did have a bit of an odd look to it with this very long initial wave, a correction, and then a very short next wave. So the market did not successfully break down on that move there, and we didn't see that upper Bollinger Band expand out there. However, what we did see is a rebound here, and the Bollinger Bands did expand as the market moved up here, and actually oil closed above the upper Bollinger Band the last 3 days. Now, when the bands expand like that, the moves are usually pretty short-lived and sharp, and to the upside or the downside. If the market is in a very weak position, they can fall for up to a couple weeks and stay below that band for 1 to 2 weeks and make dramatic price declines. But given that this is closed outside that band for 3 days in a row, it doesn't usually close outside that band much more than that. So by that measure, this move is probably topping here. So what I wanted to look at is a larger context here. What I've pointed out before is that I believe this is an A, B, C flat pattern forming here, and with oil now making a slight new high, it changes this just slightly, but not that significantly. So assuming that overall pattern is still correct and still valid, which I do believe it is, it looks like this C wave of the ABC is forming into a terminal impulse type of pattern and ending, or what's also called an ending diagonal, an Elliott wave, where we have a overlapping impulse pattern as opposed to your standard one. Now, so the pattern would actually be completing here probably this week or in the next couple of days. It is typical for the wave 5 of the 1, 2, 3, 4, 5 to slightly exceed the upper channel line or boundary line of the diagonal before reversing, and then the reversals are always extremely explosive. So we should see very quickly a move down. So this wave 4 to wave 5 should be completely retraced in less time it took to form. this wave 2 to wave 4 trend line should be broken in less time than wave 5 took to form. For this to be correct, this red line here is the size of this wave 3, so it needs to stay shorter than that for that wave type of pattern to be valid. So that's why I have that projected there. And then as far as the longer term implication, this from the October low to the end of this pattern, that wave C, if that is a terminal, impulse, or ending diagonal pattern, those are basically always completely retraced in half the time it took to form, or even less, somewhere between a quarter and half the time there. That's what this red box projects. So by basically the beginning of May, assuming we end here in the next day or two on this terminal pattern in oil, the market should completely retrace down below that October low by the first week of May. Now, given this larger context of the flat pattern, this blue trend line here should actually be exceeded also in less time than this whole wave took to form. So should be a very, very, very explosive move coming. If it's half the time, that's in basically 2 months, we're seeing a 30, probably close to a 33% price move or something to that effect there. Also, if you look at the MACD here, you have what is often called a potential 3 push pattern, where price makes a high, first high, the indicator makes its highest high, price corrects, makes a higher high, but the indicator makes a lower high, price corrects again and then makes a third higher high, the indicator corrects and makes a third lower high. So you have 3 pushes up in the market, 3 successively lower tops on the oscillator, and then that is a topping or ending pattern, and you should see a sharp sell-off there. So we have multiple things from both patterns and price, in addition to the smart money continuing to sell the oil complex and crude oil specifically at a very extreme level, given the last few years of their range there. So that's basically it for this update. I'm continuing to hold options that I purchased down at this level. I do think they'll have plenty of time to get into a profitable position. What I'm going to look at here is possibly consider exiting that option early, but I may also look to make a new option by here sometime this week, assuming this plays out as expected there. I'm also considering an option on gold, so I have to weigh that out as far as the risk and reward on that. But this pattern is a bit more clear to me with specific time and price projections than the gold market is. So that's basically all for this update. I may post some things on the US dollar euro next week, but I think we're close here. I think, get your psychology shifted to bear market mode here, or correction mode. If you want to wait for the markets to actually turn over, for the 50-day moving average to roll over, and then start playing from the downside, you can. But I would use the rising wedge lines and the channel lines that we talked about as initial confirmation that the upward pattern is complete. Have a great weekend.